Greetings everyone and welcome in today's webinar, How to Align a Robust Materiality Assessment with Corporate Strategy and Target. Great to have you here all with us. I am Shawn Mehmeti, the Portfolio Marketing Manager for Quality Management System here at PECB and organizer of this webinar. This webinar will be presented by a PECB trainer and a PECB certified trainer. He has over 5 years experience as an environmental scientist. He is the managing consultant EN2SOL PNP Limited, where he is involved in energy innovation, carbon management, laboratory automation, and management system consulting. Mr. Dotun Bolade. Please feel free to write your questions and comments in the question box in the right-hand control panel, or you can use the raise hand function. We will unmute you and you will have a chance to ask the question directly to Dotun. All of the other questions will be answered accordingly at the end of the presentation. Please, Mr. Bolade, you may continue with the presentation.
Good morning, afternoon, or evening. It's strategy and target. All right. So it's basically looking at the audits, materiality assessment, and the key of materiality to consider the relationship between materiality assessment and the new QMS 9001. Also to emphasize the importance of materiality assessment during audits and discuss materiality assessment as an integral risk-based thinking approach or method. Typically, the word materiality is usually aligned with accounting, bookkeeping. Some people even narrow it down to just a figure, which is all right. But essentially, the aim of this webinar is to see how we can define the role of risk-based thinking and the process approach, which are two very core considerations in updating the QMS 2008 to 2015. So the webinar is to serve you, whether you are an auditor, you're an implementer, or you're an accountant. Okay, what is materiality? Materiality is essentially the principle of defining the social and environmental topics that matter most to your business and your stakeholders. Very simple and straightforward definition, but it begs questions because at some point you have to ask what is important, what is more important, and then what is most important. And it's at this point that sometimes there could be some conflict between the client, not the audit client, and the auditor. Because as an auditor, you also need to have a very good understanding of the client's business to be able to be sure that what is deemed material is sufficient. It's also the first thing we have to determine in an audit, and that's because the next line of reasoning is looking at risk of materiality of material misstatement. Also, materiality influences the amount or type of error that has the potential of changing the decision of a user. Okay, so looking at it from the angle of an auditor, it limits the audit risk to obtain reasonable assurance. The auditor must place the emphasis on the processes and the systems deemed material. For instance, what is deemed material to company A might actually be immaterial to company B. A company that records billions of dollars and $50,000 might be, immaterial. But some other company running in hundreds of thousands of dollars, $50,000 might be very, very material. So defining materiality has a lot to do with context. It has to do with the size, the nature of the business, and all of that. Okay, so materiality takes into cognizance impacts, the impact, the susceptibility, and exploitability. These are key things that you consider when you're looking at materiality. Okay. Judgment, and this is because there's no standard that states that for every organization that has 100 employees, anything from $100 is material, anything below is immaterial. There is no standard that clearly stipulates all of that. So the auditor's professional judgment, very sound professional judgment, is very key in determining what is material, what is immaterial. So in doing the audit, the auditor must be able to set planning which is the amount of misstatements in the financial statement. But like I said earlier, this is just an intro. The essence of this webinar is not to go into bookkeeping, not to go into accounting. It's actually to look at materiality and juxtapose it with the standard, especially the clause 4, which talks about the context of the organization. And I think that, which is the reason why we actually drew out this topic. And just to give a breakdown, the clause 4 of the 9001-2015 standard talks about the context of the organization. And essentially, we're looking at context in terms of the internal environment. We're looking at context of the organization in terms of the external environment. And we're also looking at context of the organization in terms of interested parties. So the whole crux of it is to actually do a very thorough, which is, which also highlights the importance of the 2015 version of the standard. If you do a very thorough work in that clause 4, it helps you to narrow down on what is material, considering the perception of other parties, the management, the clients, the stakeholders, the employees. It helps to narrow down what is deemed material. Okay. It also involves the nature of the misstatement, the amount of the misstatements. The auditors must understand how these statements will be used. And like I said earlier, it's there's no hard and fast rule. That's one of that. And then there's no materiality differs from one organization to another. There are three important concepts embodied in materiality, and that's basically, material statement is considered in the context of a knowledgeable user and its effects on decision making. Materiality is also relative to circumstances. I did state that earlier. Very key concept of materiality. Materiality is relative to circumstance, and the users are considered as a group, not individually. All right, we'll look at some frameworks of materiality assessment. The revised ISA 320, for instance, talks about materiality in planning and performance of audit. There's also 450, which talks about evaluating misstatements identified during the audit. And there's also 700, ISA 700, which talks about dealing with forming an opinion on financial statements. Now there are basically looking at types of materiality based on ISA 320. There is materiality for the financial statement as a whole, and if applicable, materiality levels for particular classes of transactions, account balance or disclosures, and there's also performance materiality, which we might spend some minutes to look at. Performance materiality basically is the amount that is less than the overall level of materiality of the financial statements as a whole, and is designed to ensure that at the end of the engagement, the aggregate of the total identified and corrected misstatements and undetected misstatements will be less than the overall level of materiality for the financial statement as a whole. So basically, you are looking at performance materiality for for some reasons to allow for aggregation of individually immaterial amounts. That's part of this we're looking at the performance materiality, and also to provide a margin for possible undetected misstatements. Even at with the best of efforts, there is still the chance of undetected misstatements. So the performance materiality is very key at the beginning of the process to allow for that. Okay. The reasons for determining performance materiality, I just stated that, and basically look at some characteristics of materiality. And misstatements considered with material, when individually or in aggregate, they could reasonably be expected to affect users' economic decisions based on financial statements. Now, what we're trying to do is to look at the traditional explanation of what materiality would mean in a corporate context, which to a lot of people narrows down to financial statement and accounting, and then to gradually take it up from there into audit. Not just financial audits, audit in terms of management systems, audit in terms of whether it's QMS, whether it's environmental management systems, whether it's energy management systems. At what point do we look at issues that could be deemed material? Later in the presentation, we'll look at the materiality rule of thumb, but it doesn't narrow down materiality to percentages of financial statements alone. It doesn't. Okay. It also includes qualitative and quantitative characteristics. So you consider not only the size, but also the nature of a misstatement and surrounding circumstances. Now, the word misstatement here is very much associated with materiality in accounting. But from the perspective of quality management system, we are coming from a background of risk-based thinking, not necessarily corrective actions all the time, risk-based thinking, and that's where we are heading. That's the clause 4, basically. That's where we're headed in this presentation. I'm seeing how a very thorough understanding of organizational context can help in sorting out materiality before it leads to what we're going to consider later. What if the misstatement is more than the materiality? All right. So this is the rule of thumb: 5%, 5 to 10% of normalized before tax earnings. Some organizations between 5 and 10%. Whatever is more than 10% material, and we also have 0.5, rather not 0.5 to 1% of total assets. For some, 0.5 to 5% of shareholders' equity. And so, what rule of thumb you're using depends on the circumstance. Like I said, there's a qualitative aspect of it, just as you have a quantitative. So what rule of thumb you're using depends on the size, depends on other factors before you calculate that. Now, if misstatements are greater than materiality, then there's one of these three possible outcomes. If it's higher, the client would have to make some adjustments, or the auditor could extend procedures to isolate errors. Alternatively, the auditor modifies opinion. These are the three basic things that happen most times when you have the materiality higher than when you have the statements higher than the materiality. And so we're saying that if the size of error is more than 10% of the account balance, based on the rule of thumb, it's material, depending on the organization you're looking at. Okay, materiality assessment. Now, the essence of this, which is the core of the consideration of this presentation, is to look at the key steps to establish a robust materiality process. And materiality process can only be maximized when organizations apply a sustainability or process approach to business risk, to environmental issues, and to enterprise risk management. And so there are several materiality assessment toolkits and established methodologies, and such as the KPMG 7-step guide, which I'm going to use as a basis and compare with the QMS Data 1 2015 standard, and relate it to establishing materiality process. All right. So the first thing to discuss before looking at the objectives of the materiality assessment is that there are some factors to consider when determining materiality, and some of these factors include the criticality of the process, the cost of the system, cost of operations, potential cost of errors. That's why qualitative materiality comes in. From this point on, I'm not talking just in financial terms. I'm talking in broad auditing terms, actually, to accommodate the aim of the presentation, which is to look at the QMS 2001 and see how risk-based thinking can help you in the process of determining materiality, not as an isolated process. That's the idea, not as an isolated procedure of it's time for us to do our annual materiality assessment. No, but as part of a process approach. And for instance, qualitatively, what is the risk, or what is the materiality of having an expired license, or not even having a license at all? Financially, you can't quantify that and say it's 5 to 10% of your annual assets, but that is the basis for existence. So qualitatively and quantitatively, what is the potential cost of an error? The potential cost of the error of the client, and also of the auditor not spotting such error, right? So based on the 7-step guide that we talked about, the first is to define the objectives of the materiality assessment. And looking at this, it involves identifying risk and opportunities, engaging stakeholders, identifying future trends that could impact your company. So in breaking it into 7 steps, KPMG's 7 steps of materiality assessment, you would actually see that in running through the 7 steps, we would identify major clauses in the standard that directly address these issues. So identifying risk and opportunities. If you actually look at clause 6.1 of the 9001/2015 standard, it talks about actions to address risk and opportunities. And when planning for the QMS, the organization shall consider the issues referred to in clause 4.1, which is context of the organization and the requirements, and determine the risk and opportunities that need to be addressed. Now, this is to give assurance that quality management system, as intended, enhance desirable effects, prevent or reduce undesired effects, and achieve improvements. And so, in looking at the models or the toolkits that are available for materiality assessment, it's not stated that clause 6.1 of the KMS standard, but in stating identifying risks and opportunities, it's quite obvious from the standard that is being taken care of already, and also engaging stakeholders, which I have intentionally broken down here to internal and external stakeholders. The internal stakeholders, the employees, the board of directors, the chairman, top management, the clients, and then the external environment stakeholders. They're looking at the community, the media, what interest they have. So based on the clause 4 of that's clause 4.2 actually, based on clause 4.2 of the standard, it's actually adequately covered everything that has to do with engaging stakeholders. So in materiality assessment, what is very important to the media as an external stakeholder has to be considered as much as what is important to the members of the board, who are probably profit driven, and also identifying future trends that could affect or impact on your company. And I just call this risk-based thinking. Now the importance of this is that in setting out a toolkit, it could unknowingly or unintentionally encourage tool checkbox thinking. But in incorporating the materiality assessment into a process approach, it actually already covers. Identifying trends, for instance, is very elaborately discussed in clause 6.1, which is part of planning in the QMS, from actions to address risk, which we talked about earlier, to quality objectives. All of that is already covered under clause 6.1. So the organization identifies future trends that could impact on the business. Recently, I was reading a report about a massive company who have had to, cut down more than 90% of their staff just because other platforms have emerged, disruptive innovation, of course, who are technology inclined. So, if an organization cannot seek to identify future trends, you do not know that the risk of identifying or undermining rather, or underestimating technological advances is quite material to your business. It's not a matter of 5 to 10%. It's a matter of you could actually be out of the market in a few years. All right. So you also have to consider your audience, which has partly been covered in internal and external environment, especially internal environment. The audience has to be considered, and this item in the toolkit relates directly to the clause 4.2 in the standard, which has to do with understanding the needs and expectations of interested parties, and the interested parties that are relevant. You understand the requirements of those interested parties, and then monitoring and reviewing information about these interested parties. So these are very key aspects. All right. Okay. So also define what materiality means for your company by considering 3 key questions. The first of them is the topic of importance to stakeholders? Secondly, does the topic have social, economic and environmental impact on your value chain, which I just captured here as SWOT analysis and test analysis? And is the topic of strategic relevance to your business? Now, like I said earlier, what is material to a company that has $1 billion annual return? What is the material? Might be actually the whole business of a smaller company, a much smaller company. So, in defining materiality for your company, you have to consider these 3 key questions. Is this topic of relevance to my stakeholders? What is the weight? How important is this issue to the stakeholders? And looking at the standard again, clause 4.2 clearly deals with that. And the essence of this is to make people, auditors, implementers, organizations, to see the importance of risk-based thinking and process approach as it's embedded in the 2015 version of the QMS standard. It's simply saying, okay, understanding the needs and expectation of the interested parties. I've sat down and I've done elaborate PES analysis, looking at the political environment, looking at the economic environment, looking at the social environment, and looking at the technological environment. Like I said earlier, giving an example, technology has brought us to an era of disruptive innovation. We have companies springing up and becoming multi-million companies in months because of technology. So if you are stuck in the past, or if you are stuck in the present, someone else is thinking about the future. And it's very important because you cannot quantitatively determine what is immaterial at that point. But when you've done the proper analysis, you know your strengths, the weaknesses, the opportunities, the threats, all of these are embedded in determining what is material to my organization. Also, is the topic of strategic relevance to your business, and that's aptly covered in clause 8.2.2 of the standard. And if you actually look at that clause, it talks about determining the requirements related to products and services, and I intentionally put that here. So you need to be able to determine what's relevant, what is needed before you in the process of doing your business, and this tells you what is material and what is immaterial, right? Okay, we'll move to the next point, which is to define the organizational scope and material topics. Now, going by the issues we already discussed earlier, it's narrowing down already. You could begin to see, okay, this material issues. So you need to consider the regions or countries to be assessed. For some smaller companies or organizations, this is a one-off process. It's just an office with 5 staff, with 10 staff. It's easier at this scale to determine what is immaterial or what is material in terms of organizational scope. But in other companies, you might actually be looking at regions or countries. To give a bit of a practical example, recently in a meeting where I was a panelist, we discussed the issue of materiality, and we found out that some businesses, especially small businesses, even big businesses, in some parts of Africa where the current oil price crisis have affected um, um, the country, forex, foreign exchange has become, in fact, it actually shut down some companies. Now, you need to consider the region and the countries. For some others, it's not an issue, it's not a material issue. It doesn't matter, it doesn't mean anything. But for others, because they have to convert to foreign exchange and then deal with foreign clients, it's become a material topic. So they find the parts of a business that they're set to recover and look at the regions and countries that you need to assess. And class 4.1 of the standard is, which I've done a lot from in this presentation, talks about understanding the organization and its context. It's very, very important. In fact, it's the basis actually. The aspect of the standard that probably relates most to materiality assessment is clause 4.1, because it talks very clearly about understanding the context of the organization. And someone asked me recently during a training that why do you think the quality manual is no longer, can I use the word compulsory, like it used to be in the 2008 standard? It's optional, but of course you can still have your quality manual. And I smiled and I said, well, if you actually follow the clauses of the standard judiciously, with a process approach and risk-based thinking in mind, and you've properly addressed clause 4, then and you've addressed the issues, implemented it, then having a quality manual might not be compulsory, because it's moving us from an era of fixation on documentation, moving us into an era where the process actually changes the thinking, changes the whole process. All right. So define the parts of the business that they're trying to recover, and you can actually embed materiality assessment report as part of the performance objectives, and that's under clause 9. Clause 9 talks about performance evaluation in the QMS standard. So in the course of materiality assessment, we've touched on clause 4, we've touched on clause 6, we've touched on clause 7, we've touched on clause 8, now we're talking about clause 9, and of course, eventually, everything leads to continual improvement, which leads us to clause 10. So the whole of the QMS standard, in its entirety, and in its new approach to fixation on risk-based thinking and process approach, actually, if judiciously followed, covers most of what you need to implement in terms of materiality, especially defining very clearly your organizational scope and your stakeholders, very clearly your internal environment, your external environment. It actually helps in that regard. All right. So create a list of potential material topics based on internal data, based on that internal environment, based on media reporting, that external environment, based on environmental trends and challenges, and assign responsibility. Like I said earlier, for some smaller bodies, it's a one-off process. Just on a small body, a small organization with 10 clients or 10 employees rather, it might be easier or faster than a multinational or conglomerate of 10,000 employees in 15 countries. So at some point you might have to assign responsibility, which is adequately covered in clause 5.3 of the QMS 9001 2015 standard. And that clause talks about organizational roles, responsibilities, and authorities. And just an aside, in a recent training, PECB organized training, which we facilitated in Nigeria, in one of the classes, we had to ask participants, how many of you have clearly defined roles, responsibilities, agreed upon, and signed. And we found out that we had some few people who could not really clearly, identify what the roles and responsibilities were. They were working actually, but no clearly identified, agreed upon, signed, and understood responsibilities. But this is very key, especially in this age where a lot of industries are shrinking because of size, and then layoffs. One person is doing two people's responsibility. It's very key to look at this. All right. So consider external stakeholder engagement, and that's covered under clause 8.2.1, and also clause 4, yeah, so clause 4, external environment. So external stakeholders, particularly clause 4, but in this context I'm trying to bring in customer communication because we had already talked about clause 4 earlier. All right, and establish a continuous process for capturing changes, and that's another one standard, clause 8.5.6, also talks about control of changes. So it's obvious that I can now understand now. I can understand more clearly now why risk assessment or risk-based thinking in KMS is not localized to one clause of the standard. It cuts across from clause 4 to clause 10. Okay, and the next thing now is to categorize. In the process of categorizing, you can refine the list of potential material topics by clustering them in categories. For small organization, it's a one-step process. You can make sure everyone involved in the process understands the specific risk or opportunity, as we at least talked about in we actually looked at these clauses earlier. And then connect every material topic to relevant external trends, which is the pest analysis. I just talked about the risk of some companies being out of business just because of technology. Today, take pictures, talk about the internet, the social media, technological advancement, which is driving our age, is going so fast that if you're not updated, you could be out of business before the blink of an eye. And then, gather information about the impact and importance of topic. All of this is gradually winding us down into the end of, toward the close of the materiality assessment process. The aspect of gathering information that we talked about, but more elaborately, carry out pest analysis of each topic. So once this is done properly, it gives you an appreciation of the impact and the importance of every topic that you have highlighted, all right? And then you can prioritize, prioritize material topics based on the strategic importance of the business, based on the importance to stakeholders, and based on the analysis you've done earlier for each topic. So, but in this case, we have to, quite quickly note that in prioritizing what is important to the stakeholder, you could actually, or you should, get the views of the stakeholder. And if you look at the standard for clause 4.2 talks about the external environment. Now, the point is this: in the process of gathering information about the stakeholder, you could use different avenues, meetings, workshops, emails, newsletters, questionnaires, feedback. But whichever way, it's good to have a good appreciation or appraisal of what is important to the stakeholder. What does the stakeholder deem important? And this helps you to prioritize the material topics. All right, and it's also prioritize based on the impact on corporate values, corporate policies, the mission, the vision, the core values, the objectives of the organization. What if it's an NGO or for profit? The core corporate policy helps to, prioritize what do we deem is material, what do we deem is immaterial, all right? And it can also develop a scoring methodology to impute from various sources. Then you engage management at some levels. Of course, management usually could actually, facilitate the process of materiality assessment, but it's very good to interact. We talked about external stakeholders earlier, and then this brings us home to the internal stakeholders, and so that you can validate the outcome and then recommend what action the board should take, which is part of performance evaluation. All right. Now, seek stakeholder feedback. We talked about that earlier. Integrate the results into corporate strategy, corporate governance, and then operations and reporting. At this point, it's obvious that we are already talking about continually improving the management system, continually improving the topic. Now, the importance of this is we have moved gradually from looking at materiality assessment in terms of just a figure. It's a 5%, it's a 10%, and that's all. and then you just, when there's need for an audit, you quickly look for your total asset, net returns. You can get 5%, and then you say this is materiality. You've moved from that to a risk-based approach, to a process approach that integrates the relation from the inside out, from the internal environment to the external environment, to interested parties. We looked at almost every clause of the standard, and we've seen that just the way ISO has integrated risk-based thinking into the whole of the standard, the materiality assessment process, rather than encouraging checkbox tick, just tick tick, it brings us a point where we can look at it from a holistic perspective, both qualitatively and then also quantitatively, right? Also, in terms of materiality and risk, basically materiality is the magnitude of a statement, while risk is a measure of uncertainty, right? So that's just the basic summary of materiality and risk in this context. Right, so what are the common challenges that we face in the process of materiality assessment? One of them is incorporating and prioritizing stakeholder views. And like I said, if you are coming from an angle of very robust implementation of the QMS standard, it becomes easier to assess this challenge, to address this challenge, because you're really looking at, you've taken a very holistic approach to appraising the stakeholder views. You've done all of that, so it becomes easier. But if materiality assessment is a process that is just, you have a checklist, once in a year, just go around and as a reporting tool, just for the sake of scaling through an audit, then incorporating the stakeholder views becomes difficult. Also involving senior management and extending the materiality assessment beyond companies' own operations across the value chain. Now, this also lends credence to what I just said earlier concerning the first challenge that we listed, and that extending the materiality assessment beyond the company's operations involves the stakeholders, involves the whole of the chain, from the internal environment, the process, the products, the services, the external environment, the media, the community, the environment, technology advancement, and all of that. And also, materiality assessment is isolated from the rest of the business in a lot of organizations. And this is the simple explanation for this is it has no bearing with process approach. It's just isolated from the rest of the business, and at some point you pick a checklist and then you just go around, you sit down, what is material? What is material? All right? And then you narrow everything down to a dollar figure, and that's all. And it's all over. That's all about materiality. But if it's not isolated from the process and it becomes a part of the process, then it's easier to do a materiality assessment based on the process approach. Sometimes material topics are very broad. The first challenge actually boils down to what is material. What is material? And so if you have a very good understanding of the context of the business from the three aspects we have mentioned: internal environment, external environment, and interested parties, then it becomes easier for you as a body or a company to define what is material. Like we said earlier, what is material to a $1 billion company what is it material rather to a $1 billion company might be material to a smaller company, right? And so tick box mentality is the last challenge I actually outlined here, and that's basically what we said earlier. Isolation. It's a completely isolated process from what you're doing. You just take a notepad, take a book with check boxes, and then you narrowly define what is material. All right. So the essence of all of this is to see that materiality assessment from the qualitative perspective and quantitative perspective, both for the corporate body and for the auditor, actually has been addressed in the QMS standard comprehensively in each and every single clause. It's not an isolated clause. You probably will not even see the word materiality assessment, but from the process approach and the risk-based thinking dimension that the standard has been written from, it has actually addressed most of the issues that have to do with materiality. So when people ask me about materiality, I tell them try to define very clearly the organization, the context, and makes materiality assessment much easier for you. I hope you've had as well time listening to this webinar. We've not had enough time to begin to take the rule of thumb one by one and look at every aspect of materiality. But I think this the intention to drive us home to the standard. I hope you got that right. Thank you very much. I'll hand over to Shawn now. Thank you.
Thank you, Dotun, for this great presentation. Also, I want to apologize for the technical issues during the presentation. Now, with the time left, we will go ahead with some questions. Therefore, if you have any other questions, it's time to ask them. Please use the comment box or raise your hand function. Thank you. Okay, Mr. Bolade, the first question is, do you have an example of materiality assessment or materiality cases to show us how to understand reality in the work process?
Hello, can you take that again, please?
Okay. Do you have an example of materiality assessment or materiality cases to show us how to understand reality in a work process?
Oh, all right. It's like I said earlier, if questions like this, we could actually send maybe like an assessment example, like on spreadsheet via email. It's difficult to show that right now. But the underlying principle, like I said earlier, is for instance, for example, a company with an inventory loss of $50,000 undetected by the auditor, be judged in the material if the company is $1 billion company revenue, even from the rule of thumb. Like I said, some people just take 5% of the net returns, and then 5 to 10%, and whatever is less than that is immaterial. Whatever is higher than that is immaterial. But that's in strictly financial terms. But if you want to use the toolkits to understand the various aspects of the standard and use it to kind of do an assessment, then it will go beyond this presentation. Right? So I could have those kind of questions in email, so I could send a template. All right. Thank you.
Okay, then thank you, Dotun, for this answer. Because of the time limited, we will have to conclude this presentation. However, if you have any other questions, you can send your questions through email, and we will answer them accordingly. Thank you again, Dotun, for this clear and informative presentation. I want to thank all the attendees as well for taking the time out of your busy schedule to join us today. We hope you enjoyed the webinar. To keep up with the webinars, please check PECB webinars or our PECB.com webpage and social media network as well. Since next week we are organizing a webinar on interesting topic, why ICO 9001 is a necessary tool for organization during a global oil industry recession. Thank you, Dotun, for this informative and great presentation. Goodbye.
Thank you very much, Shawn. Welcome.